And I can bring in our final guest, of course, it's Paul Welch from Nostra Terra Oil and Gas. Welcome, Paul, calling from West Texas, Dallas. Sorry, I said
Yeah,
from
yep,
West
I'm in
Texas. You're
Dallas
in
today.
Dallas. Yeah, yeah.
Yep.
How are you?
I'm good, thanks. I'm really good. Thanks for having me.
No, no, good to be speaking. Always good to be catching up. So, of course, you got your assets in West Texas. You got a new well, oil well that you're planning to spud. I think it was the end of summer. Was it the autumn about that time? I
In the
think.
summer, yeah, beginning of autumn, end of summer. That's the plan.
End of
Yep.
summer, yeah,
Yeah.
excellent. But perhaps just to start us off, people who are new to this company, just introduce us to the company and its strategy. The whole
Sure.
theme of this live stream is small caps making money, and you're definitely doing that. You're definitely
Okay,
a
well, I'm
small
glad to be part
cap.
of that, thankfully. Okay, so NTOG is as an onshore Texas oil and gas producer, primarily oil, with our assets in East Texas and West Texas. The primary asset that we have is in East Texas. It's called Pine Mills. It's a field that the company purchased about 9 years ago. It's a shallow field with good quality reservoirs. It's a conventional producer, so it has long life, low decline wells. I mean, the field was discovered in 1945 and it's still producing today. And so we're producing about 150 barrels a day in total. Our operating costs are very low because we're in Texas. We have shallow reservoirs, and then we have access to any number of good quality service companies, so we can get things done relatively cheaply, which is one of the reasons we're still making money at these prices. Our net back at $75 a barrel, which is a long way off now, was about $50 a barrel. So our operating
Mm,
costs are about 25. At current prices, we can probably just scale that back by $15. So our net backs are probably closer to 35 to $40 a barrel now, when they were higher before when the oil prices were up. But we're in good shape. We did a change in management just about a year ago this week. So we significantly changed the company up a year ago. And so from that point forward, we've just been focused on generating revenue, paying back our debts, and putting money into projects that can generate a return. And so that's
mm.
been kind of the theme for the last year.
Well, the last year was certainly a big, significant change for the company, not just on the management side, but as you say, changing some of the ways you operate there. Could you just perhaps go over the immediate changes that the company made with cost cutting and reviewing of the current assets that have been in the portfolio of the company for a long time?
Yeah. Well, I think the issue with Pine Mills has been in the portfolio for quite some time. The prior team was looking at growing, and they were looking at growing kind of globally rather than growing locally. So when I came on board, we had a kind of a very scattergun kind of approach to what was happening. And so what we did immediately was just look at all what's making money, what's not, what is making money, what can make money, what's not making money. Things that were making money, we kept and invested in. The things that were making money, we sold or put on the sale bin. We haven't sold everything, but we sold assets that weren't core or strategic or felt that we could get there. But something like Pine Mills, which was the primary asset, we went out and raised money and put a lot of money into that field, and we've essentially doubled the production over the last year in that field through our investment program. So because the field, had been picked up 9 years ago and then used essentially as a cash source to put into other opportunities. When we came on board, there were essentially 10 wells that were idle, that were capable of being returned to production, but just hadn't been invested in. Subsequently, we've taken 9 of those and returned them to production, and taken the field and essentially doubled it. We were producing just over 100 barrels a day last week. We peaked production at 140 barrels a day, which is where we should be. But weather and power and other issues have worked against us. So right now we're just above 100 barrels a day, and we are targeting 140 by the end of the summer. So that's our plan.
Okay.
And
Just
yeah,
on that point, sorry,
yep,
Paul.
yep.
Yeah, I know 140 was your target. So you say what it's weather and what affects the
Yeah,
production?
yeah. So it's 100. It was so we made 144 barrels a day. So we hit our target for a couple of days, which isn't great. We need to hit our target every day. And the issue we've had in the spring has just been weather. It's what I describe as a weather power issue. The field is operated by electricity, so all the pumping units, vertical pumps are all electricity driven. And we've had in this last 2 months, so in April and May, we've had twice the number of storms and twice the amount of rain that we have in a typical over 30-year period. So, we've been up and down due to these thunderstorms coming through, and that's then things will flood and shut some wells in. So that's been really kind of nipping at us hard. The new wells, or the wells that we returned to production, a few of those we raised up above the floodplain, so they're sitting up on. I think we showed some pictures of them. They're sitting up on perches above the water, not a problem. But some aren't there, and then it's a place called Pine Mills, which there are lots of pine trees. It's a pretty beautiful place, but when the storms come through, they knock the pine trees down, knock limbs down, and have issues with our power source. So we put more money into essentially running new lines. We just ran a new, some lines we buried, other lines we just trimmed the trees up. So it's been a constant source of trouble for us over the last 2 months. But we're getting our heads around it now, and I think moving forward, we don't expect to see this kind of level of storms for the next 6-7 months. But we've had in the last 2 months, they've really caused us some problems. But we identified that, and so the wells that we worked on are fine, and the wells that we hadn't worked on obviously suffered a little bit. So those are the ones that we have to get after. Now, the other issue too is when oil prices were higher at $75 a barrel, returning things to production quickly was something we did. Now, as prices drift down, below 60 and 50, some of the marginal wells that are making 2-3 barrels a day, we're not going to rush out to put those back on because it doesn't really pay out for a period of time. I mean, I think the thing that we had impressed upon all the investors that were involved early with us was that everything we did was going to pay out within a year. And mostly that's true. The oil prices come off about $20 a barrel, or 20%, sorry, about $15 a barrel. So that has lengthened that time, but everything payout times were between 1 month and 13 months, and with the average being 6. And so we might be slightly more than that, maybe 7 months, but everything we've done has to pay out within a year, and so that's what we're focused on. So as oil prices drop and wells that are making 2-3 barrels a day come off, we'll probably be slow to put those back on until prices come back up.
Okay, and that's just to save cost, effectively.
Yeah, I mean, again, we want to, we have other places to put our money that probably has a better return than bringing a marginal well back on. And so, we'll use it to, drill the next Falcon well, which I'm sure we'll talk about.
Sure.
But I mean, those are better uses for the cash than putting a marginal well back on in a low price environment.
But are you happy with the workover that you've done and the production of the
weather?
Yeah,
for sure.
You're not using weather as an excuse. It is genuinely the weather that's
No, I mean, you guys can check the records. Again, we hit it when we made the number that we were expecting. 144 is the peak. But we've just had a tough time keeping things up and running with all the weather we've experienced. So as these things dry out and as we move forward, it's going to be we can check the weather and see if that's good. We've had double the amount of rain and double the number of storms for the last 2 months, not just 1 month. So it's been a consistent pattern, but it should be like today is beautiful. So as things dry out, we'll put things back on and it should be fine. A lot of times. We have 6 feet of water, and so the well's sitting up above, above the water. But our guys and pickup trucks can't get down there and service it in case it goes down. So it's been a little bit of a challenge. But it's just one of those things. It's something that we'll manage and we'll get through it.
Okay, good. And just in terms of your experience, because I know you've been a director of the company for quite a while, but your experience and the team's experience at Nostra Terra working in this industry, but also perhaps this West Texas area specifically.
Right. So we changed that. So again, a year ago is when we had the big change. So I was on the board for the 2 years prior to that. And my experience has been, I'm a petroleum engineer by background. I have, almost 40 years of experience. Went to the Colorado School of Mines, University of Texas, and then went to work for Shell for 15 years, came out and started to work for smaller companies like Hunt Oil, Pioneer Natural Resource, and a few others. And then, got involved with the smaller AIM companies, which are challenging and a lot of fun to work with. And so I have a lot of experience, again, on the production side. I'm a petroleum engineer. When I came on board, we brought someone else with me, which was one of our biggest investors now, a guy by the name of Jim Newman. Jim and I know each other for a long time. Jim comes from the service sector. He's worked onshore Texas Permian, East Texas for his entire career. He's also from the service side of the business, so he knows what it takes to, get things up and running, what we should be paying for things. He had a number of service businesses and a plugging company, so he's very familiar with old well bores, how to get the most out of them, and how to do it profitably. So again, we changed up the team. Steve Staley, our chairman, remains. I became the CEO, and then Jim came on as an NED, and that's the entire board and team at the moment. We just kept it very small, kept our costs low, and just focused on what we knew and what we could bring to this to make things, improve things, and get things back on production, which is where we needed to be to start making oil and increasing production. So that was the team change, and we think it was a very positive thing for the company.
Good. Yeah. Thank you, Paul, for that. So just going back to phase 2, the workover that you've been doing here. How are we complete on that?
We're
now?
done.
I know it was.
We're finished with them. Yep. So we finished with them about 2 weeks ago now. We got the last power line in.
Okay.
Everything has been up and running, but as I said, as those wells are up and running, some others have come off, so we haven't seen a complete spike up. But when we brought the last well on, we made just over 140 barrels a day before the next set of storms hit us. So we're clearly capable of doing it. We just need to get everything back up and running. But we identified 10 wells when I first came on board. We put together programs for 9. We funded those, and all those wells are now up and running and on production. So, a lot of cases, these wells hadn't been produced in something like 7 or 8 years, and so they're up and running. We're making anywhere between, in the low case, probably 5 barrels a day, and in the high case, 15 to 20 in some cases, depending on the day, from these wells. So it's been a good addition to the production. Like I said, we doubled from where we started. Every barrel that we make is a profit center for us because our costs are fixed. All the facilities are in place. They've been in place for 50 years. So each incremental barrel is just something that we ring the cash registers for. So we're really focused on getting that incremental barrel across the line. And again, with the cost thing, also because we divested ourselves of most of the opportunities that weren't making us money, we lowered our operating costs corporately by 25%. We raised production initially by 40%, so that allowed us to increase our netback by almost 50%. So we increased the profit per barrel significantly from the time we started, which has really been helpful.
Well, it's good to hear that phase 2 is finished. So in an ideal world, that's 140 barrels of oil per day,
Correct.
effectively.
Yeah.
Okay. So that's good. What does that? I don't know what you can say on this publicly, but can you talk about what that covers? Because I know you've said you're profitable both at the operational and at the corporate level. So I mean, does the production from these wells cover the cost?
Yeah, it covers everything. It covers the whole. Because we have some debt that I inherited, and we have our operating costs. So we're profitable at both the operating and corporate level at the moment. We'd like to be more profitable. We had a little more price help. We would certainly be up and generating a lot more cash. But at the moment, we're I think thankfully we started this process a year ago, and so the drop in prices obviously hasn't helped our cash flow. But we're in a position now that we can absorb it and not be where we started this process. Which when I came on board in May of last year, we were losing like $50,000 a month. So now in a good month we're making 20 to 30. So it's been a significant turnaround from where we started. And had the oil prices stayed up, we would have been much higher than that. But it's been a big change in the way we operate and the amount of cash we generate. And little help on the prices would certainly make a big difference because our costs are essentially fixed. And so as prices increase or as production increases, that flows straight to the bottom line. That's what we've been focused on.
So you say what, 20 to 30,000 US a month, roughly?
Yeah, that's what we're making now. I mean, I have to check the numbers, but it depends on the oil price. But that's what we're doing. That's what we're looking at.
Okay, so that covers the cost. I guess there's still some overheads and things that probably aren't covered in that. Fees on the listing.
Everything. That's everything. We're covered everything.
Directors' fees as well.
Covered.
Okay.
That's our debt. That's our overhead. That's our operating costs. Everything's covered. We are truly a profitable business. Yeah.
You're truly right. Okay, that's fantastic. That's great to hear. It's good to hear you. Only worth £1 million on the stock market, and most mining companies are.
That's a problem. That is an issue.
Are losing money, not making money. Okay, so I'll get onto that in a moment. So now that that's done, then with Pine Mills, does that mean that your focus now is on Falcon and that drilling of that well that you agreed with your partner to do earlier, well, a couple of
Right. So
months ago, I
we've
guess
been
it was.
focused on the Falcon area for a while. Falc is, it's kind of a misnomer to call it a different part of the field. Falc is essentially the southwest corner of the field, and
Okay.
so it's an area that's been there since the field was discovered in 1949. But until a 3D seismic program was shot around 2018, no one knew the extent of this fault patterns. And there's an area down there that has essentially fault separated from the rest of the field. That 2 wells, well, actually, in total now, the 5 wells have been drilled down there, 3 by offset competitors and 2 by ourselves. And those 2 wells came in 2022, producing at 120 barrels a day. Okay. 120 barrels a day and no water, right? The average Pine Mills well makes between 6 and 10 barrels a day and has a water cut of between 80 and 90%. Again, Falc is very different. In the Falc area, we're producing clean, dry oil, 120 barrels a day. Our operating costs are less than $5 a barrel. So this is a significant, increase in our cash flow when these wells come on. Now, those wells came on, in 2022, produced, at the field limit of 120 barrels a day, flat out for a year, then declined, and now they have stabilized the 2 wells at 100 barrels a day in total. So we're making 100 barrels a day from those 2 wells, and it's been flat since May of last year. And that gives us confidence that the area to the north of where these wells are located is a larger section of the reservoir, and that's the area in which we've mapped not only 1 but 2 potential locations. We're going to drill 1 this year, and hopefully we'll drill a second one the following year. Or, if prices stay low, why can't we drill it this year? Because the demand for casing, for rigs, and everything has come off with this decrease in pricing, decrease in oil pricing, and that has softened up the market for workover rigs and for drilling rigs. And so potentially we can get these wells drilled at a discount to where we originally drilled them. That hasn't,
Okay.
we haven't firmed that up yet. That's something that's a work in progress, but it's something to look forward to. Now, the other part of the story too is what we haven't mentioned to anyone up to this point is that there's a tremendous amount of water flood potential down in the Falcon area. So at the moment, we're just producing a primary. You're not putting any water in the ground. So as these wells, as the natural reservoir pressure declines, the wells decline. Once they get to a certain point, then we're going to implement a secondary recovery program. And like the rest of the Pine Mills field, we'll start increasing the pressure in the reservoir, which will increase the rate of flow of these wells. And so we'll be back to producing, hopefully at the field limit at some point in the future once then we implement that. Now, that's also something we discussed with not only our partner, but our offset operators as well to see if we can implement that flood. And that's an ongoing discussion that we're having to see, how quickly we can implement that. So the Falc area, pays, pays dividends multiple ways. And again, 2025 is when we're going to start to reap benefits of the next set of rewards from the Falc area in our view.
Okay. Well, thank you, Paul. I do see some questions coming in. I do want to get on to them in a moment, but
Sure.
just before we do that, if you could just answer this. What sort of production numbers would you expect from the new well, and when? What are the next steps to actually get it online once it's been drilled?
Okay, so the well is going to come in around 120 barrels a day. 100,
Okay.
I think 124 is the field limit, so that's what we expect it to come in at. We have a third of that well, right? So our net will be 40 barrels a day from that. That's what we
Okay.
expect. The next steps are we pick the location. Now we have to go out and stake the location, build it, and get a permit for the well, and then go out and tender for the rig and for all the consumables. We've put off the tendering for the rig and the consumables just to see where things are going to move from a pricing perspective. Things we see to be trending down. Demand is off. A lot of companies have pulled back on their 2025 programs, and we think that will benefit us as we move through 2025 in the form of lower costs for both services and for some of the equipment. The flip side of that is that we have some tariffs that have been implemented on some steel and aluminum products that aren't helpful. But overall, we're seeing a change in price of about 10% on tubulars. So we don't think it'll be that big of a deal. So that's what we have to do. We have to get the permit. We have to stake the location, build a location, determine access, that sort of thing. On a map, it's easy to pick out where the location is, but then when you get on the surface, you have landowners you have to deal with, you have access roads, you have a big rig you have to get in there. So all that is happening at the moment. Now, the important part that I think everybody needs to know is that we are a 1/3 owner of this, and we are not the operator. So we have, through our own technical work and our own stories, and the things that we've generated, we've convinced the operator that this is a good thing to do. Now it's down to the operator to execute it. Now, obviously, we're there to help them. They're very good partners to us. They did a great job on the first 2 wells. But again, they're a private company. They're going to do things in their own time horizon. And at the moment, the timelines I'm giving you are the things that we've agreed with them. Now, it may change if we have a hiccup with, securing a rig or thing like that. But it is going to be a 2025 spud. We'd like to do it at the end of the summer, put the well on in the 4th quarter, and start producing it before year end. So that's our target, and that's what we've been shooting for. But again, that target is about a quarter behind where we originally expected it to be, because our partner just had to get themselves up to speed. They had a very different view of the subsurface than we did. We did a lot of technical work. We had a number of meetings with them, showed them what we thought, and we got them on board. And now they're completely on board, and they're going to run. They're going to run with the ball. That's such a we handed them, and so
Good. Okay.
So that's where we are. So, ideally, we end the year with a production rate between 170 and 200 barrels a day. That's what we're looking at, and that will require us to get Falcon up and running.
Right, 170 to 200 by the end of the year with new Falcon.
With Falcon, correct.
Yeah. With Falcon, okay.
Yeah.
Okay, so that's okay. So that's 100. Is that 100 from the Pine Mills plus 120? Is it, or no?
Yeah, we need about 120 to 130 in Pine Mills and another 40 from Falcon.
Oh, 40. Sorry, from okay. Yeah. Oh, yeah, because you've got a third. Sorry, I'm forgetting a third.
And then we'll get, again, assuming that we get everything else back up and running, we should be closer. But I don't want to overpromise here. We need to deliver on this. So
yeah, that's fine. That's fine. Okay, I'm going to just bring in some questions, Paul, because I do see quite a few people that are interested, which is obviously a good thing.
Good, yes.
Like the story. Okay, so what is the production barrels of oil split between Pine Mills, West Texas, and Falcon? And previously, CEO has stated the company makes money above $25 a barrel. So why are some wells not worth it as producers?
Okay, so we produce about our operating costs are around $25 a barrel for sure. Where we have an issue is like we have a very marginal wells making 2 to 3 barrels a day. Again, it's the capital required to put that well back on production. Let's say we have a casing leak, or you have to bring a workover rig in and pull the tubing and rods and replace them. So it's just a matter of cost. How much is going to cost us to return it? If the well just is down because of power, and we just have to flip the switch and turn it back on, or rewire something, we do that. But it's just a matter of cost when you get to these marginal wells. Now, any well that's above 5 to 6 barrels a day, we'll put on almost straight away. But it's just these marginal wells, when they get below 5 barrels a day, you're just okay. Is it worth it? What's it going to cost us? And we have to look at all those things, because, as I said, we're targeting payouts in under a year. So anything that's longer than a year, we're probably not. Yeah. So and again, it'll depend on water cut too. So some of these wells, they may make 2 to 3 barrels a day, but produce 200 to 300 barrels a day of fluid. The fluid has to be treated and disposed of, and that has some power cost to it. So it's a variety of things that we look at when we're looking to turn wells back on. But that's where we are. So as far as numbers go, we should be about 120 to 130 in Pine Mills, 40 from Falcon, and then we'll get 10 to 15 from West Texas. That's kind of what we're looking at the moment.
Okay, another question here. What is the plan to get to the stated 5,000 barrels of oil target within 3 to 5 years? And why does the company not report production and profits every 3 months? Quarterly basis, yeah.
Right. Okay. So for us to get to 5,000 barrels a day, which is the target, we're going to need to do an acquisition and need to do some development. So ideally for us, what we like to do is get involved with something that, is similar to like a Pine Mills type of opportunity, where it's a mature field, has been invested in for quite some time. Maybe the company ran into some debt issues or something, take that over, and then go back in and kind of do a redevelopment. That's what it'll take. Now, we can't do that with our existing asset portfolio. We're going to need to add to it. So it's, these are opportunities we're going to look at. And so, and it'll be a period of years. That won't happen overnight. But just because we couldn't raise that much capital and deploy it that quickly. So that's the time horizon we're looking at. As far as reporting on a quarterly basis, I mean, we're on AIM. We're required to report on a semi-annual basis. We'll continue to do that. We try to put out something at least monthly. As far as putting out things quarterly, obviously that's something we can look at. It'll depend on what's happening, things we'll do. But we internally we do everything on a monthly basis. So to change it to a quarterly reporting thing, we can do that. But then you get audited, unaudited, these type of things. So it's there's more to it than just putting out production numbers. But as far as internally what we do, we look at everything on a monthly basis. So
okay, well, monthly reporting is good, I think, in the first instance anyway. As you get things going, it'd be nice to keep investors up to date on what's going on a monthly basis. Right, let's have a look at this one. Why does the company not pursue more creative finance, such as have oil companies like Europa Oil and Gas, Zephyr Energy, and Cirque Energy? Too many placings are destroying shareholder value and the share price.
Well, again, we're a small entity, and so you look at those companies. Somebody like Serica. Serica is a very large company. I knew the former CEO quite well. We're just a very small opportunity. So to do creative things requires, I think, bigger opportunities. We're not opposed to that. But again, something like the bigger thing we're working on now is Falcon. Falcon is something that we're taking on with a partner. We're paying a third. The partner's paying 2/3. We're both benefiting from it. So we are, to a certain extent, doing something along those lines. As far as creative goes, obviously I'm open to ideas, but they have to be scalable to the type of opportunity we're looking at. So, you're bringing on 6 to 10 barrels a day. If you're not bringing on 100 to 200, the way in which you can do those type of opportunities is slightly different. So again, we're open to ideas. I don't want to shut anything down, but at the moment, the opportunity set is really focused on what we can do internally and not especially with a partner beyond something like Falcon.
Right? Okay. I know you've got your drawdown as well that you could maybe utilize to drill Falcon. Could you? When is it
So that's a good point. So when I came on board, that up until now, that facility has been maxed out, and so we've been just trying to ensure that we don't run afoul of keeping that where it is. As I think we've reported in January of this year, we renegotiated that facility for another 3 years at very competitive rates. And so we're going to have our first redetermination of that facility this month, in June, next month. And so at that point, we'll see. So, we have two competing factors there. We have increased our production on our reserves by a certain amount, and we've seen prices come down by a certain amount. So it's the let's call it the yin and the yang of that. Have we increased it to the point where there's going to be more headroom available? Or will the price deck they're using, essentially take all of that away? And that's what we're going to determine in June. In our view, we've increased production by more than 50%. Prices have come off by about 20%. So we should be generating some headroom in that facility that could be used for other things. Now, also, we would like to do everything from cash flow. We don't really want to use any investor equity or any more debt to do things. Cash flow is our preference, but those things are going to be available. Hopefully, this facility will increase as in line with the production numbers that we've realized, and so we'll see. But it'll be a combination of the two. So we're always looking for opportunities to do that, to look for creative ways to spread our capital around. But up until today, literally today, there's been no availability in that facility. It's been maxed out.
Do you perhaps think that the low valuation of Nostra Terra is potentially a fear of funding? Where that's going to come from?
It could be. I mean, it could be. I think in the past, the company prior to my involvement had raised a lot of money and not really delivered on what they said we're going to do. We've raised money since I've been here, and we put it all into the ground, and we've seen the production, increase. Now prices have come off, which hasn't helped, but we've done what we said. We need to continue to do that, and until investors are convinced that we're delivering on what we intend to do, I think there's going to be some skepticism. It's going to keep the price low. So, my job and the job of the board is to, reiterate the fact that we're putting money into the ground. looking for good opportunities, and these opportunities are delivering value to shareholders. And until people see that, I think they're going to be skeptical, and they should be. And so, it's really up to me to deliver on what we've said, and I think we're doing that. The production's up, the values are up. We'll see with the increased facility what kind of headroom we get. But it's just one of those things we got to watch the space. Had the prices not dropped off, I think we'd be in a much better position. But because of all the work we did in the past, even though prices have dropped, we're still in a good position because we're still profitable. I mean, like I said, prior to May of last year, we were losing between $40,000 and $50,000 a month, which wasn't great. Now we're making money, so it's a significantly different company. But that needs time to bake in and generate and pass through to the store to the investor base. All they've seen is our 3 raises, but those raises were needed to start to get these wells on production. And so, so I understand people's concern, but I think we're in a very good position now to grow it going forward.
Okay. I can see there's about 3, possibly 4, I think, in one of the Telegram groups. So I'll just go through them. We can take a few extra minutes. Why has the company not employed a chief financial officer with oil and gas experience? It's clear that there's a potential knowledge gap in current management. I don't know if that's a dig, Paul, or not, but anyway, the CFO.
Yeah, I mean, it's a matter of cost. So we have experienced people on a contract basis that are working behind the scenes that don't wind their way into our presentations and into our public disclosures. But we're operating in Texas. There are a lot of very experienced people in Texas, and there are people behind the scenes that are filling that role for us on a part-time basis. And so when the company grows, we get to the point where we can afford a full-time CFO that has industry experience, we'll add them to the mix, or we'll just promote them up to the board to do that. But at the moment, we need to keep our costs low and essentially share that experience around with other opportunities and other with people, just share that cost, because at the moment we can't afford it. So so they are there. They're just kind of on a part-time basis.
Okay. So something to bring in later. Okay, so it's a cost-saving measure. Okay. Last question. This is all from the same investor here. The company's raised 1.4 million in the last 3 raises, but only increased production by about 50 barrels of oil per day. So it cost nearly 30,000 per barrel of oil. That's too high. So is that right? First of all, and what's your comment on that?
So we've sustained a 50 barrel a day increase. We've got it up by 100 barrels a day. We just need to continue that. So I mean, again, it's a matter of getting through this weather window, and then getting the resilience in the system to allow us to produce this 140 barrels a day that we need. That we're looking to do based on the investments we've made. So it's going to take some time. We needed to also pay back some people that were owed money when we came on board. So not every single penny went to the ground. Some of it went to people that were owed money in the past. And also we have a $4 million facility that needs to get paid each month. So a big chunk of the revenue that we generate each month goes towards paying the debt. And again, the debt that was there when I came on board doesn't really benefit me per se, because that money has been spent. Now it's just a cost for us. So not everything we raised went straight into the ground. Some of it went to pay back some past payables, and then some of it is used to pay the current interest on the debt that we have. But I think as we move through the remainder of the year, that price per barrel will drop as the production continues to increase.
Okay. Thank you. So I did see one question that came in on the Nostra Terra Telegram group. Again, I don't know what you can say on this, but the question is, are there targets for production to increase over the next 6, 12, 18 months? It would be helpful to know what the company thinks is achievable. The previous CEO was happy with 100 to 140 barrels of oil per day for years. Paul says he wants more. So targets end of this year, end of next year.
Okay, so we gave me the target at the end of this year. It's going to be between 170 and 200. That's what we're looking at. Beyond that, I think we've given you the kind of the full cycle target, which is to get to 5,000. Between there and those 2 points, there's a lot of open space. We haven't done our budget for next year yet, so we don't know where we're targeting. But let's think about some scenarios here. Falcon comes in, we have the Falcon 3, potentially a Falcon 4. That's going to be another 40 barrels a day. And then we start implementing a water flood. That could be another 100 barrels a day on top of that. So, organically, we're looking at another 150 barrels a day. So ideally, we'd like to, add another 150 barrels a day in 2026. It'll depend on the success of Falcon 1, if there is Falcon 3, if there's another follow-up, and then the implementation of the water flood. So those are the things that we can see in the near term. Beyond that, I think it's going to take some opportunities, both from recompletions in the field that we're working on at the moment. We don't have any hard numbers on, and also some acquisition potential out there. What we haven't really talked about is these soft prices are not great for our cash flow, but there are opportunities out there where people that haven't been in our position to kind of clean up their story over the last year need to sell. And so we've seen some opportunities that are priced quite competitively. And those are the type of things that we potentially progress if we stay in this kind of lower price oil environment where we are at the moment. So some acquisitions would certainly help and add to the production base. And just so it's clear to everyone, we're only looking for producing assets that have development upside. So we're focused solely on generating cash from day one of things that we purchase. So that's what we're looking for. So we don't have further targets beyond the end of this year at this point, but obviously we will look to those when we start our forecasting and our budgeting at the end of the summer. So that's really all I can say about that. You've got the end point, you've got the end of the year, and then there's a scaling thing that has to happen between those 2 points, which we're focused on.
And your targets are based on barrels of oil per day rather than profit, for example. That's your metric that you're focusing on.
Yeah, we're focused on. I mean, again, our costs. Well, our costs are relatively fixed. So the more revenue, the more barrels that we can generate, the better for us. So and then the other thing too is with a cash target, it implies a certain oil price, and at the moment the oil price is changing so frequently, it's difficult to pick one. We picked $75. And we were pretty comfortable that was going to be a decent price, but as you can see, we've come well off that. So, budgeting next year will probably be closer to 60, and then from that we'll generate a whole slew of targets based on that cash flow. But at the moment, with the way prices are moving around, we're focused more on barrels a day than anything else.
Okay, no, that makes sense. And I don't know if what you can say to this. I just quickly worked something out just based on what you said earlier about what you're sort of making on a monthly basis at 20 to 30,000 US dollars, based on 170, which is what your target is for the end of the year once you've drilled Falcon 3. And I know these are conservative values. Obviously, that's based on the current oil price. So that gives me a 400,000-ish number, and that would be sort of like a profit. I don't know if that is
for profit for the end of the year. I think we should be better than that. I mean, again, I can't predict the oil price, but the thing with the Falcon barrels is that our operating costs are less than $5. So the net back on a Falcon barrel is significantly higher than the net back on a Pine Mills barrel, and so the numbers will scale based on that metric. So if let's just pick a price. The oil price is $60 a barrel. We're probably going to be making $50 a barrel in profit on a Falcon barrel, just to put it in perspective. So there is upside to that number because of the profitability of the Falcon assets, right? And then we have to pay taxes and some OPEX and stuff too. So it's not all 100% profit, but it's a significantly profitable number. That's why the Falcon area is really key, because the numbers and the amount of cash we generate from that area is significant compared to Pine Mills. But it's all profitable, which is an important thing.
Just one last question. I know we're getting a little bit late for the roundtable, but it's okay. We won't go over time. But there's a lot of people watching, and I know a big thing with Nostra Terra is you've got Premier Miton, haven't you, as a pretty significant shareholder now. They obviously want a return, so they're very supportive of your of what you're doing. So I think there's like two questions here. I know Gervais sees a lot of value in Nostra Terra because it's basically $1 million market cap company that's profitable now. So I mean, do you have conversations with Gervais about how sort of supportive he is, and does he say anything to you about what he likes about the company, and how can you get that value up to give Gervais a return and shareholders?
Yeah. So, I mean, again, I think so. We talked a little bit about how to get the value up. The value up is we have to continue to deliver on our targets. We have to get out there and promote the story, show you we're making money, show you how things are improving, and show you where the funds that we have raised have gone into the ground and generated a return. With regards to Gervais, I think we don't talk individually or daily or anything about what we're doing, but from Gervais, it was an overall plan for the company. Say, look, Gervais, this company needs to improve. These are the opportunities that we see out here. These things pay out within a year. They are very profitable. Our operating costs are very low. We're onshore Texas. We're in a very good environment in which to operate, and so our ability to generate cash here is substantial, and it's that ability to generate cash that I think caught his attention. Now, obviously, I can't speak for Gervais, but these are the type of conversations to have. He likes things that pay out quickly, are low cost, and are repeatable. And so we showed up with 10 opportunities, of which we executed 9, and I think that's what he liked. And so as we move forward, we're going to continue to do that. We're going to look for lower cost opportunities that generate cash from day one and allow us to grow the business in an organic basis, as we move through the future. So Gervais has been very supportive. They're an 18% shareholder at the moment. We hope they continue along those lines, and we hope we deliver opportunities to them to allow them to continue to grow their position. We have other stakeholders in there that have, like Jim, or one of our board members, is a significant shareholder, and there's other investors there too that have backed us and want to see us grow. So they all like the low cost conventional play that we're doing in East Texas and to a lesser extent in West Texas. But those are the things that we're going to continue to focus on. And then we think that, being successful in delivering more of those opportunities will allow us to increase the share price and also for Gervais and others to invest more into the company and turn a profit.
Excellent. Thank you very much, Paul. Thank you very much for
Thank
that.
you.